The more time you spend investing, the more experience you gain. But sometimes you just need a reminder of some basic rules you need to keep in mind. I will give you 6 advanced investing tips for beginners and experienced investors. Let's go. Welcome everyone, welcome back to the Finance Kid. As always, my name is Dion and I'm here to push your financial mindset towards a better reality. In this video, we'll go over 6 advanced investment tips you should always keep in mind. It is never a bad idea to get a refresher or simply improve your investment skills, is it? And by the way, for those of you that are part of this community and you have already subscribed, welcome back and thank you very much. And if you haven't subscribed yet, well, what are you waiting for? Go ahead, hit that subscribe button right away because I will bring you personal finance tips and investing tips in the future. Smash that like button as well and let's get started. First thing you want to keep in mind at all times with your investing strategy is to stick with your goals. If you're in your 20s or 30s, your financial goals will be a lot different than if you're in your 50s, for example. So make sure you have that plan. You have those investing goals of what you want to achieve and stick with it. You don't want to be a traveler without a destination, do you? Don't buy a stock just because somebody told you to if it doesn't fit your trading style or goals. Consistency is always significantly rewarded in the stock market as it negates the risk of making the wrong choice. A friend of mine, about 3 or 4 years ago, made a huge mistake like this. His portfolio was doing great, but he decided to sell a big portion of his long-term investments and jump into a short-term quick tip. And yeah, overall he lost over $5,000. Not only that it will take time to recover those losses, but it also causes doubt and disbelief in you. So stick with your strategy. If you're a day trader, well, buy and sell quickly. Don't hold a losing trade open, hoping it will recover. If you're buying for a long-term goal, like retirement, for example, don't panic at short-term market drops like we saw in March. Does that make sense? Let me know down in the comments if you're more of a short-term or long-term trader. Dollar cost average over time is your second best friend for a long-term trading style. Keep that in mind. If you buy assets regularly over time, you will get the best possible price compared to trying to time the market, which is something we shouldn't do. So as you dollar cost average over time, this is why you need to save as much as you can from as early as you can. Time is your best friend in investing. I'm sure that you must have heard that time and time again, and it is accurate. The key to building wealth is compound interest over time, which causes your money to increase exponentially without the need for you to change anything. Compound interest is what makes your money work for you. Compound interest accumulates over time, and the more time you give your investments, the faster they will grow. Here's a quick example. We'll do $1,000 invested with a very conservative 6% a year return on investment. Now, if you did that when you were 20 years old, in 45 years, when you retire, you will have $13,764. But if you waited and didn't start investing for your future until you were late, let's say 40s, for example, you would only have 25 years to work before the same retirement age of 65. and you would have only $4,292. That is almost 3 times less money. If you have any questions how compound interest works, let me know down in the comments, please. And in the description, I have a great calculator you can use to visualize those returns so you can get an idea of how it works over time. So make sure to check it out. Next on the list is cost of investing. Yes, cost matters a lot. There is a tendency of investors about only focusing on the returns and not looking at the cost involved with them. Jack Bogle, the founder of Vanguard, said that cost is the only thing that matters. Well, I'm not sure if it's the only thing that matters when you're an investor, but it is a big factor. You have to make sure that you're aware if you are paying fees to buy and sell assets, for example, in your brokerage account. You also have to make sure that the costs to manage your assets are reasonable. When you calculate the effect of cost on your investments, it can be huge because costs directly affect the returns you can achieve. Every tiny change makes a huge difference because of the compound interest over time. So if the mutual fund you like so much all of a sudden changes its expense ratio from 0.1 to 0.2%, that might be an insignificant number at glance, but over time it adds to thousands of dollars that you don't get to keep as profits. You should always take into account the expense ratio if you're looking to invest in funds, or if you're investing in individual stocks. The trading fees of your brokerage account are very important. Make sure you're aware of your costs and try to save as much as you can from those. Hit that like button, by the way. It helps a lot. And if you want to share the video with more people, that would be very much appreciated. Thank you. Now, with all that said, we cannot forget about automation. Couple of things that I personally like to automate at all times. Those are depositing money and rebalancing my portfolio. Depositing money for investing and savings should be on autopilot. Figure out how much you want to save and set those deposits directly from your bank account to your brokerage account once or twice a month. You don't want to miss those deposits. And why is that? Well, dollar cost average. Remember, the more consistent you buy assets, the better price you will get over time. It is a proven fact. The other thing I like to automate personally is the rebalancing of my portfolio. You can do that in one of two ways. You can buy mutual funds that have set dates in the future to rebalance, or you can use a service from your brokerage account to do so. Rebalancing is important because, again, over time, your goals and needs will change. If you're in your 20s and 30s, you can afford to be more aggressive in the markets because you have time. But as you approach retirement, that will change and you will need to be more conservative. Let me know down in the comments if you have any questions about rebalancing. I'm more than happy to help. And number 5 tip on my list is one that I'm sure you have heard thousands of times probably, but yet many people still don't listen or follow. Diversify. You need to diversify your portfolio. And you can do so by using different investments, different industries, different asset classes, and so on. As cheesy as it sounds, do not put all your eggs into one basket. There is not a single company in the world that I would like to put all my money into and set and forget it. And I don't care if that's Amazon or Apple or any other company out there. You never know what might happen, like a pandemic or a financial crisis. And if you don't have a diversified portfolio, your risk is a lot higher. Just like with dollar cost average, when you diversify your portfolio, you negate a lot of the risk. It is highly unlikely that all your investments will not be profitable if a well diversified portfolio is compared to another one that holds a single company stock. Diversification is vital in every stock market investing strategy because you don't want to be invested in a single company only to see it failed. And yes, that is a possibility for every company out there. Diversification protects you from any severe losses. It is that simple. And lastly, you have to try and reduce your taxes. And no, don't avoid paying taxes. Don't try to hide taxes. This is not a good way to go. But do try to reduce your taxes in any way you can. Taxes are essential for the economy, but it's not suitable for your portfolio. Best thing you can do is consult with a CPA or a tax attorney. But the easiest thing you can do to reduce taxes is take advantage of trading or retirement accounts like 401k or an IRA, which is an individual retirement account, which gives you tax benefits on your investments if you don't withdraw money early, of course. Therefore, you can even diversify your portfolio into different accounts with different tax benefits. Quick example. Roth IRA is one of the best retirement accounts you can open. That is because you deposit money after taxes and your investments grow tax-free. In most cases, that is very helpful because you're more likely to be in a lower tax bracket now than what you will be in the future. So there you have it, all 6 advanced investing tips for beginners and expert investors. Let me summarize them for you. Stick with your goals. Save as much as you can from as early as you can. Pay attention to the costs of your investments. Automate as much as you can. Diversify for more protection. And lastly, try to reduce taxes that you would pay on your investments. If you follow those tips, you'll be in great shape over time. Don't panic. Time is on your side the longer you're in the markets. So stay positive and master your finances, as I have been saying in every video. And with all that said, thank you for watching. Make sure to destroy that like button. Subscribe if you haven't already. Not sure what you're waiting for, because I will continue to bring you valuable content you don't want to miss, working around the clock for you and sharing my experience as soon as physically possible. Thank you if you're a subscriber already to my channel. Don't forget to hit the like and share button as well. I hope this video was informative and provided some value to you. Down in the description, you will see other helpful links along with that calculator that I mentioned. Thank you for pushing your financial mindset towards a better reality. Until next time, stay positive, master your finances, and take a good care of yourself and those around you.